Hey, this is Kyle Roush with Iron Gate Realtors. Hope all is well. Today I'm talking about financing a real estate transaction, more specifically on the buying side of it. We're going to cover a couple topics today. First one being a little bit about the history of the mortgage industry and how the process works in general. And second piece, a lot of those specifications or qualifications for a mortgage and how lenders are determining how much you can qualify for. So let's talk about that first. There are really five major ones. First one is monthly income. Second, down payment. Third, credit score. Fourth, debt to income ratio. And fifth, cash in bank. So why do we have these qualifications in the first place? Well, you've probably heard of Fannie Mae and Freddie Mac. They're two large corporations that buy loan packages or buy mortgages from lenders, local banks, credit unions. They bundle them together and sell them off as mortgage-backed securities to investors all over the world. So what that means is those local credit unions or those lenders want to be able to qualify to sell the loans to Fannie Mae and Freddie Mac so that they can get the capital to make more loans, right? So it's kind of a revolving process. But Fannie Mae and Freddie Mac want to bundle loans together in similar risky loans or similar risk loans in order to sell as mortgage-backed securities to investors. So therefore, the lenders, the local banks and credit unions need to be able to qualify their loans to sell to Fannie Mae and Freddie Mac so that they can bundle and sell off as mortgage-backed securities. So that's why that process is there. Now, 2007-2008 recession, what happened there was a lot of subprime loans were given. Basically, that means loans were given that fell just outside of the criteria that Fannie Mae and Freddie Mac set, and the local lenders, the banks and credit unions set as well, or have as well. And so what happened was those loans were given, those subprime loans were given. The consumer defaulted on the loan that affected the bank, Fannie Mae and Freddie Mac, the mortgage-backed securities, the investors, and the financial market as a whole. So the U.S. government stepped in September of '08. Bailed out Fannie Mae and Freddie Mac to keep them in operation, and both those companies are operating under a conservatorship of the U.S. government so that the recession of 2007-2008 doesn't happen again. So let's get to those five qualifications. First one, monthly income. Typically, lenders are looking for a monthly income for a mortgage to be 25 to 35%. So the mortgage payment itself, the monthly mortgage payment, needs to fall between that 25 and 35% of your monthly income. Now that mortgage payment has to include everything, not only the mortgage, but insurance, taxes, fees, HOA, sort of everything bundled into one needs to fit within that 25 to 35%. Second piece, down payment. There are a handful of loan packages available, and down payments can range all the way from 0% up to 20% as a minimum. A conventional loan is going to land you at 20% down payment or more. An FHA loan is 3.5% down payment or more, and some VA loan packages even have the ability to have a $0 down payment. Now, talk to your lender and discuss what's best for you. Discuss it with your spouse if you're purchasing a home with your spouse to decide exactly where you want to land as far as the down payment is concerned. Third piece, credit score. For a conventional loan, to get those advertised rates, the 3.5 or 4% that we're seeing right now, you need a credit score of a 680 or better. Now, it doesn't mean you won't be able to qualify for a loan if you have less than a 680, but typically 580 is kind of the bottom of the barrel. A 580 credit score will qualify you for an FHA loan, 3.5% down, like I said before, and anything better than 580 plus will qualify for you for a range of different loan packages available. Fourth piece, debt to income ratio. Typically, lenders are looking for a debt to income ratio not to exceed 36%. Now, that doesn't mean if you have more a debt to income ratio higher than 36%, you can't get a mortgage. There are a handful of additional specifications that can qualify you if you do have something higher than that. A good example are doctors. When they graduate, they may be making six figures, but they also have 6 figures of debt, to pay back. Doesn't mean they can't qualify for a mortgage. They just have to, meet some additional specifications. In that case, it's a very, very high income. Last piece, fifth piece, cash in bank. This basically gives the lender the ability to stave off some of the risk because you have a lot of cash in bank to be able to cover the mortgage if something happens, like a job loss or a lot of health bills come up. So those are really the five pieces. There are a handful more qualifications that determine what you can qualify for as far as a mortgage is concerned, one being the home itself and the neighborhood that the home is in. But those are the five major ones and the ones that you should focus on. So to leave you with a couple other tips about financing. First thing, get pre-qualified. If you're considering buying a home in the next 6 months or even a year down the road, go to a lender, get pre-qualified to determine where you should start looking, what price range you should start hunting in. Second piece, once you find an agent, talk to that agent about different neighborhoods, what you're able to afford in one versus another, and also any pieces that you really want in a home. Say you want a man cave, so the whole basement. If you're going to put 20 grand into a home when you move in to get the man cave of your dreams, you want to make sure that the home and the neighborhood can sustain that investment and that you'll be able to get your money back, or at least a large portion of your money back, while doing those improvements. And then the last piece I'll leave you with is make sure that you have enough liquid cash to cover ongoing costs or maintenance costs of owning a home. Especially if you're renting now, you're going to run into a lot of maintenance costs such as yard work, maintaining the home and keeping, upkeep of the home itself, as well as any other improvements that you need to make to the home to make it exactly what you want. So make sure that you have enough liquid cash beyond the mortgage payment to take care of those pieces.
My next video is going to cover financing as well, but more on the selling side of the transaction, so stay tuned for that. It's going to cover a handful of pieces. One is going to be improvements that you can make to a home to increase its value and the rate of return that you should expect to see with those improvements, as well as some general information about cost to close and what it really takes to sell a home. So stay tuned for that. Thank you so much for watching. If you have any questions in the meantime, feel free to reach out. You can call or text me at 937-397-3905 or shoot me an email at kyle.roush@irongaterealtors.com.